I think it's a very positive step that we have a regulator that's finally acknowledging some of what's actually happening in the market. To be honest, a lot of our clients were doing these activities prior to the law coming in, and some of them were doing it even after the law came in without having realised that they needed a licence perhaps. So I think what this is a recognition by the regulator and a response to what is in fact happening in the marketplace. In terms of Hong Kong's prominence in fintech, I think that is a little bit grander statement. It would be wrong of me not to mention Singapore in the context of anything around Hong Kong. Singapore already has a stored value regime very similarly to the one that's in place now in Hong Kong. Other jurisdictions do already have similar types of regimes in place. So I don't think we could necessarily say, well, look at this, Hong Kong is a leader in this space. But against that, I think if we look at some of the more traditional Western economies, like in Europe particularly, where they're now looking at a new payment services directive, which still isn't yet law, they're catching up actually to Hong Kong. So if we compare ourselves perhaps to traditional markets in Europe, we are very much ahead of it in terms of that regulatory regime. However, there are other areas, I think, and it's an interesting question that this is the only one fintech area. I've been grappling this morning on a particular issue for a client around robo-advisory issues, both in the banking and also in insurance context. And it's another area where when we're doing an analysis across multiple jurisdictions, actually Hong Kong hasn't got clear guidance about robo-advisory, autonomous systems pulling up recommendations about investments and things like that. So actually in some areas Hong Kong is lagging behind in this area, and hopefully we will see some greater clarity and more recognition, I guess, of what's actually happening in the market. It's obviously one of the core issues when we've been in dialogue with the Monetary Authority. They have this very challenging position where they don't want Hong Kong to be the front page story around the world when there's a major cyber incident or some sort of major loss of creditor money because of an issue that's occurred. So they are extremely concerned about not only the protection of client monies, and we are talking about a deposit facility here, so client money protection is a core objective, but also the reputational damage that a major incident might have on Hong Kong's standing as a global financial sector. So I think it's a really important issue. But against that, we've got clients saying, well, we're operating these services globally. We could use Hong Kong as our hub, or we could use somewhere else as our hub. And would you like to encourage us to be here and actually use this as our hub, set up in this city, direct all of our global payment services through this market rather than perhaps a market somewhere else in the world or even in Asia. So I think the MA also has an eye on their business development objective in continuing to maintain Hong Kong's position as a leading financial services centre. So if they make it too difficult, they're going to potentially dissuade people from setting up here. But that needs to be balanced against the risk that if things are too lax and we have major problems, then that could have a negative impact. So it's quite a delicate balance, and it's a balance that we've been definitely involved in our dialogues with the regulator to try and persuade them to find ways of fitting some of our more innovative client solutions within their regime, even though what we're finding is a lot of the ways that clients are delivering these services doesn't fit very neatly into the way that the regime's been established.